CBA predicts a 2021 economic recovery. Let's have a look. Hello everyone, Florian.Heise here, and welcome to another episode of HeiseSays. Grab your stein of coffee, and let's have a look at this article from Mortgage Business, because CBA is predicting a 2021 economic recovery. That's right, the same CBA which is at the top of our stock market, biggest market cap, one of the big four banks, which was also warning about significant property price falls just before the government intervened and helped prop up the market, and who promised to not repossess any houses until September this year. Now they're predicting an economic recovery when we still have job seeker propping up many businesses by keeping people employed, and we've got a job seeker bonus, which is, well, giving more money to people who may need to adjust to even less with our unemployment rate just, not doing too well, everyone. I'll bring this up. So let's look at this. CBA economists say they foresee strong economic recovery in 2021 after a weak 2020. And the increased use of fiscal policy, there we go, in conjunction with monetary policy to manage the economy. This is the thing. The idea that you can actually manage an economy, you can't really manage it. Everyone who tries to manage or centrally plan an economy eventually fails. It's an emergent system. We can't model the full complexity of it. We can only attempt to. But then the further out you push your predictions with timeframes, the less accurate your predictions are. That's why I would advocate for less intervention in the market, but there doesn't seem to be a political will for that here in Australia. So we're going to have more and more people who plan to manage the economy. We've got slogans saying we're better economic managers, one party to the next. Frankly, I think they're all trying their best, but it just tends to, put more resources unfairly to the people on their side. We couldn't have a system with less interference, smaller government, and more local level engagement in politics. That'd be a bit nice, but we'll have to see. Let's have a look at this, the CommBank prediction. So the Commonwealth Bank of Australia's chief economist, Stephen Halmerick, has outlined his economic predictions for 2021, stating that while 2020 would likely be the weakest year for the global economy since World War II, 2021 is expected to be a healthier economy. Well, it's depending on so many factors. Commenting on his predictions, Mr. Halmerick said, "We do expect a solid recovery in 2021, with global growth forecast at 5.2%, led by the US and China. In the US, there remains a number of political risks ahead, assuming Joe Biden is sworn in as the 46th president of the US on the 20th of January 2021. We expect him to focus on a few key policy priorities that should support the US economy throughout 2021 and beyond. While the spread of the coronavirus pandemic has had a significant impact on the Australian economy, financial markets and monetary and fiscal policy, Mr. Halmerick noted that the impacts have been less severe in Australia than originally predicted. Australia has done a better job than just about any other nation in controlling the spread of the virus," he said. This, combined with fiscal and monetary policy support being provided to the economy and the role played by the Australian banking system, means the economic impact of COVID-19 has been less severe in Australia than many other nations, and less severe than initially expected. While noting that Australia's 30 consecutive years without a recession came to an end in 2020, and the steep rise in the unemployment rate as a result of the COVID-19 crisis, Mr. Halmerick said that the outlook for Australia is improving. Monetary policy will remain. So if it's improving, why is monetary policy still necessary? That's the thing, they're going to prop up the economy, and then they're going to slowly try and wean the economy off life support and hope that it can stand on its own. Now the problem is that whenever you do that, there's going to be some businesses that start to fail. We're going to start to see that happening with regards to these insolvency rules changing. I think it'll happen this quarter. Once the BAS bills start appearing for some businesses, you've got JobKeeper taking a hit. If not this quarter, it'll be next when JobKeeper finally disappears. Then you'll start to see insolvencies ramp up. They're running at about less than half of where they should be. And I know that sounds like a good thing, but you always have some churn in business, guys. Nothing's perfect. People go out there and try and run a business, and sometimes it doesn't work, or, a client just doesn't pay, or maybe you're giving credit to someone and they're not running, they're insolvent. So then you topple over as well. Sometimes things beyond your control. So that's why generally the average Think about it, we've had our first recession in 30 years, and insolvencies are half of where they have been during all those good times. That worries me. And that means we're going to get a spike in insolvencies. So, the recession, the rise in the unemployment rate, the global economic environment, and the expectation that inflation will remain below the 2 to 3% target range for years has seen monetary policy in Australia enter unconventional space for the very first time. Well, the question is, will we enter negative interest rates? Will that appear this year? Remember, right now, our cash rate is a bit of a joke. Hang on, I'll bring up this chart. It's a bit of a joke. We're sitting there, I updated this chart for when we went down to 0.1. You can see maybe a pixel on that chart if you're looking at a high res. You know what? I need to upgrade to get my old 4K screen out and start recording in 4K again, just so when we look at this chart, we can see the difference in the cash rate. But joking aside, it's ludicrously low. Remember when 3% was considered an emergency low rate? That gave him no room to move. Now, the only way to move is negative. So the question is, are we going to see negative interest rates here in Australia this year? That's the question. Let me know if there's a tab bet on it. We should probably put $50 on it just to see, if we'll hit negative rates this year. The cash rate target is expected to remain at just 0.1% for at least 3 years. The Reserve Bank of Australia is funding the banking system for 3 years at 0.1%, and the RBA is targeting the 3-year Commonwealth bond yield at 0.1%. In addition, the RBA is now engaged in a quantitative easing program and will buy $100 billion of Commonwealth and state government bonds over the 6 months to April 2021. This strategy provides the nexus between monetary policy and fiscal policy in Australia. The RBA governor insists that the RBA is not financing the government directly, but the $100 billion QE program will go a long way to supporting the Commonwealth and state governments' borrowing programs for 2021 and likely beyond. Having entered the world of unconventional monetary policy, it is going to be a long time before the RBA can retreat from providing significant support to the economy. Now, there's the other thing. Is it actually going to be possible for the RBA to retreat? With the political climate that we have now, where we're in a snowflake world, cotton wool world, is the government in charge going to put pressure to ensure, support continues from the RBA for fear of losing an election? Because if they start pulling out fiscal support, what's going to happen? If monetary policy starts increasing the cost for government borrowing, and it all starts flowing through, and then we start seeing businesses falling over, what's going to happen? That's the thing. Look what happened in the US when they tried to normalize rates, guys. The market said no, slapped them around, and, well, they undid it real quick, didn't they? So the policy focus on jobs. CommSec's chief economist Craig James predicted that while the RBA is expected to hold interest rates at its record low for 3 years, the focus for 2020 would be on forward guidance, monetary policy objectives, and the increased use of fiscal policy in managing the economy in conjunction with monetary policy. While monetary policy was once all about adjusting interest rates of the price of money, that is no longer the case, he said. In a recent address to the Committee for Economic Development of Australia annual dinner, RBA Governor Philip Lowe said the RBA is now undertaking QE similar to other central banks. I mean, that's the thing. We're in a global economy, so you can't really, they can't do anything else. They have to go lockstep with all the others, or else we're gonna be done. They don't have any choice, really. So, quantities and prices are obviously connected, so QE works partly through the effect and the price of money, including long-term risk-free interest rates, he said. But there are other effects too. When the central bank increases the quantity of money and buys assets, liquidity in the financial system is increased, and investors in the private sector need to purchase other assets with the proceeds of the bonds they sell to the central bank. These portfolio adjustments can affect the price of other assets and international capital flows, as well as the exchange rate. Commenting further on this, Mr. James said the goal of the RBA's focus on QE or bond buying is to drive interest rates lower for the longer term, reduce the debt servicing costs for government, and to reduce the funding costs for banks. Borrowing costs for Aussie households and businesses are at rock bottom, driving a housing market recovery while encouraging firms to invest and hire workers, he said. Who's going to invest and hire workers in this economy now? You'd have to be brave. You'd have to have a lot of government work in the pipeline. The policy is primarily focused on job creation to reduce scarring in the labour market, and I appreciate that. That's the biggest trap. You get intergenerational poverty brought on by this recession. So there you have it, everyone. CBA's predictions for an economic recovery in 2021. While we have, can we really say the economy's recovered when we've got such an artificially low cash rate, such a high unemployment rate, and such significant government money flowing into the economy? You tell me. As always, guys, thanks for watching. Please like, share, and subscribe to the channel. If you're a fan and want to support the content I create here, there are a few ways you can. You can join us on YouTube or Patreon. Support us using our affiliate links at Amazon, eBay, Independent Reserve, or AussieBroadband. You can buy our merch from HeiseSays, use Gold Pass from the Perth Mint, or support us via PayPal. Take care, everyone, and I'll see you next time. Bye for now.